An increasing move towards strategic stockpiling, for example, Project Volt in the US, is expected to threaten the availability of above-ground stocks. Supply-side concerns remain prevalent at the start of the year, with an increasing move to tighten trade policy on a global basis being compounded by the uncertainty attached to the Iran war, higher energy prices, and logistic bottlenecks, with aluminium taking centre stage. An accelerating move towards defence spending, green and digital applications will support demand prospects for key metals such as copper, aluminium, and tin. The outcome of China's 2 sessions meetings has indicated that growth in the largest producing and consuming country for base metals is set to slow in 2026, with no additional year-on-year stimulus forecast. The start of the Iran war has added to rising geopolitical tensions, with uncertainty over sustained inflation and its impact to global growth prospects, casting a shadow over base metal demand in the year ahead. Western manufacturing faces headwinds from an altered path for US monetary policy, with our house view for no rate cuts this year. Here we address how our view on the suite has altered since the start of the year, based on our key price parameters, the outlook for the macroeconomic environment, underlying fundamentals, and the role of investors. The macroeconomic landscape has darkened, in which global manufacturing faces headwinds from an altered path for US monetary policy. Our house view is for 0 rate cuts in 2026, from 2 25 basis point cuts expected previously. Now note here, this delays the outlook for a recovery in the global industrial cycle, with falling yields having a net positive impact on base metals. In addition, the reduced expectation for rate cuts in 2026, combined with ongoing developments of the Iran war, has resulted in the US dollar entering a bull run, with investors flocking to US dollar-denominated assets, capping base metal gains. Looking to China, we have limited expectations for robust stimulus this year, which alongside structural property weakness, deflationary pressures, record low consumer confidence, weak investment demand, and increasing concerns for external demand, with exports accounting for 1/3 of GDP growth last year, this could result in headwinds for China to meet its modest economic targets. And finally, the combination of an uncertain trade landscape and ongoing conflicts such as Russia and Ukraine have been compounded by the development of the Iran war, creating potentially longer-term headwinds for global manufacturing and base metal demand overall. Turning to the role of investors, at the time of writing, global positioning towards the base metals is highly divided. On the Shanghai Future Exchange, net short positions for copper, nickel, aluminium, tin, and lead are at multi-year lows. However, on Western exchanges, with the exception of lead, net longs prevail. Now, this regionally divided view indicates that the markets lack a clear global trend, with extreme levels suggesting that sharp price corrections could just be around the corner, and that understanding the realities within the underlying fundamentals for each metal is pivotal for the months ahead. Looking at aluminium, it's been the best performing base metal on a year-to-date basis, up 15.7%, and it remains the only metal to continue to post gains since the 28th of February, the start of the Iran war, with prices rising to their highest level since March 2022 on the 1st of April. The diversion in performance versus the rest of the suite is driven by aluminium's reliance on Middle Eastern production, accounting for 9% of global output, 23% of ex-China production, with a minimum of 75% of what is produced being exported through the strait. Now, with the strait effectively closed, there are no other shipping routes that have a similar capacity, and we would expect the near-term impact to result in ingot inventories building up, with a longer-term impact to result in smelter run rates reducing or stopping altogether, given the region has such a high dependency on raw material imports, with domestic production of alumina at 9%, but bauxite at just 1.2%. Indeed, we've already heard that the Quantalim smelter in Qatar is operating at just 60% due to limited gas supply, while in Iran, the Bandar Abbas smelter is being curtailed, with the Iraq smelter impacted. However, following Iranian missile and drone attacks on the 28th of March, specifically targeting smelters deemed to have, quote, affiliated with and related to the US military and aerospace industries in the region, we are still assessing the impact from damage to the Emirates Global Aluminium Al Tawila smelter complex in Abu Dhabi, which is 1.6 million tons of refined aluminium, and also Aluminium Bahrain smelter, additionally another 1.6 million tons a year of production there. Now, disruption could hold the potential to remove as much as 50% of Middle Eastern aluminium supply, equivalent to 11% of production outside of China, and around 5% of global output, with smelter damage representing a longer-lasting supply shock rather than just a temporary curtailment. In this scenario, the aluminium market will move from a balance to a deficit which would far exceed 1 million tons. Furthermore, the potential outlook for higher energy prices could challenge global aluminium's producer margins, with aluminium the most energy-intensive base metal to produce. And all of this is set against a backdrop in which aluminium stocks are depleted in the US from the introduction of import tariffs, and in Europe, given the move away from Russian stocks. Having said this, healthy Chinese production and increasing exports of aluminium products will help to offset near-term tightness, although it is unlikely to materially change the surge in regional premia. The length of the Iran contract will be pivotal for this metal, while a prolonged war would necessitate further demand downgrades, partially offsetting supply losses. If the conflict were to end within the next 2 to 3 weeks, demand conditions would materially be less negative, while supply damage will persist. We will await the reports from Alba and EGA. Tin has closed Q1 with the second strongest performance of the suite, up 15.3%. This, however, appears modest versus the 42% year-to-date jump posted on the 27th of February, in which tin posted an all-time high of $57,728 per tonne, just before the US and Israel struck Iran. Now, tin's robust performance was driven by compounding supply-side concerns. Indeed, in 2025, more than 40% of global mine production faced a form of disruption, including within major producing countries such as the DRC, Indonesia, Bolivia, and Myanmar, resulting in refined output coming in flat, just up 0.3%. Meanwhile, at the start of this year, the announcement from Indonesia, the second largest tin miner in the world, vowing to close 1,000 illegal mines in the country, while also moving to a 1-year from 3-year mining license requirement, further inflamed supply concerns. Now, in Myanmar, the third largest producing country in the world and the largest importer to China, they faced armed conflicts in the Gujarat region, although no mining disruptions were mentioned. Despite this fragile supply-side outlook for tin and steady demand projections, with consumption supported by tin's use in high-tech, defense, and digital applications, we believe that tin has peaked for this year, with a notable exit from net long positions across key exchanges, including the LME and the Shanghai Future Exchange, attached to building global stocks, which at the time of writing are up 38% year-to-date, hovering just below their all-time record high. Meanwhile, Chinese trade imports have rebounded, with tin ore imports up 88% over the January to February period year-on-year. Looking ahead, ongoing approval for Indonesian mining licenses and Myanmar's move to cost share on deep mine shaft dewatering should see tin ore trade with China expand further, moving refined output into the country back into the green. Zinc is the third strongest performing base metal of 2026, with recent price strength driven by supply-side dynamics tightening, with a focus on zinc concentrate imports to China from key countries such as Russia and Iran, while mine output will be closely watched from key projects such as Red Dog and Antamina. Here, if production disappoints, it could put pressure on benchmark treatment and refining charges. However, healthy output in China is expected to partially offset these risks and keep the market in a building surplus, alongside frail demand dynamics, with the outlook for zinc's largest end use in galvanizing steel, such as construction, under ongoing pressure from an ailing property market in China and uncertainty in global growth prospects since the start of the Iran war. Nickel has managed to hold on to gains, closing Q1 up 2.8%, with prices charting a new trading range of $18,756 per tonne to $16,820 per tonne over the course of the last 4 months, a very significant change from the range of $16,828 per tonne to $14,084 per tonne level, which was recorded over 2025. Behind this has been supply-side disruptions, with Indonesia, the world's largest producer, tightening the country's nickel ore KRAB production target to 260 to 270 million tonnes, down from 379 million tonnes last year, in addition to vowing to crack down on non-compliant or illegal mining, where even the largest nickel mine in the world, PT Weda Bay, faced investigation. Having said this, we expect nickel to remain in a surplus market this year, with global stocks at their highest level since 2017, in addition to expectations for flexibility on mining quotes over the year. Copper ended the quarter in the red, down 0.7%, wiping out gains that had resulted in copper posting its highest nominal level on record on the 29th of January of $13,618 per tonne, a year-to-date jump of 9.6% and a year-on-year jump of 50.2%. The outlook for copper has significantly dampened over the course of this year, however, with the central crux regarding low inventories reversing. In the US, the COMEX LME arbitrage has inverted, resulting in material diverting away from COMEX warehouses and into LME sheds. Meanwhile, outside China, Shanghai Future Exchange stocks have rebuilt at such a pace that on a seasonality basis, they're at their highest level on record, while LME stocks have jumped 165% on a year-to-date basis. So given this, all in all, visible exchange stocks are up 76% on a year-to-date basis to their highest level on record. In turn, the LME forward curve has reverted to a contango structure, indicating no near-term tightness. While the longer-term outlook for copper remains bullish, with a concentrate market deeply in deficit, a clouded macroeconomic outlook, rising stocks, and a pullback in investor appetite is likely to see copper prices correct and hold to the downside after extreme volatility in Q1. Meanwhile, lead, which closed Q1 down 5.4%, continues to reflect a moderate backdrop for traditional industrial metal demand, set against a somewhat protected supply outlook, given lead's unique fundamentals in which 2/3 of supply comes from secondary sources. If you want to learn more on what to expect in the commodity world these next few months, I encourage you to visit our platform using this QR code. Thank you for watching.